What's going on, guys? Welcome to Stock Talk with Nico Kritikos. Today we're going to be talking about PE ratios, Warren Buffett's investing strategy, and what you should be looking for when you are buying a stock. So in the past, Warren Buffett has said that he looks for stocks that trade at PE ratios of 15 or under. And so generally people think that the smaller the PE ratio is, that the better the deal they're getting and the cheaper the stock is, which on a surface level basis it is, because if you pay 5 times earnings, then yes, that is cheaper than paying 30 times earnings. But there's a little bit more that goes into it. And if we go back to Warren Buffett's strategy, the other thing he has said is that he would rather pay more for a high quality company than get a good deal on a low quality company. So that's where there's a little bit of a contradiction there. And I'm definitely more on the side of buying a higher quality company and paying more for it versus getting a company that, although it's super cheap, it kind of is struggling or they're just going downhill. Because in the last probably 12 months to 18 months, there's been several times, probably 5 times or more, where I've seen a stock and it's struggling a lot. Maybe it's down 50% or 60%, and the PE ratio is something super cheap. Let's say it's like a 7, or let's say it's a 9, or something where it just looks really cheap. Well, a lot of times there's a reason for that, and a lot of times those downward trends of the stock can last, over a year, if not a couple years of that stock going down. And some of these stocks are big names. I remember I bought into, I think it was Big Lots. I bought into sometime earlier this year or last year. That's a company where, it was kind of like a trap. And then there's other companies that I bought into, like really big names. You could look at Verizon, AT&T, Walgreens. There's a bunch of big name companies where the PE ratio might be a 7 or a 10 or something cheap, but the stock keeps going down for 12 months, if not. Walgreens, I think, has gone down for multiple years on end. And so they're kind of like a trap, because for those companies, there's a couple different reasons. One, a lot of times they have a high dividend yield, which kind of is more of a trap for investors to get into the stock. And then the other thing is they either have a lot of debt, and so that holds the company back. Another thing to look for is is their net income and free cash flow growing? Because that's a bad sign if their free cash flow and net income are the same numbers that they were doing 10 years ago or even 20 years ago for some of these companies. That's a bad sign. The other thing to look for is share dilution, because these companies will pretty much just keep diluting shareholders, and that pushes the stock price down. And so the company never actually makes any progress. And that's why you always look at the stock and it looks like it's trading at a cheap valuation, but when you buy into it, you don't really make any money. And maybe you look at a 5%, 6% dividend yield and you think, oh, this is such a great deal and I can't wait to get that dividend money. But then you end up losing way more on the stock price. So that's why they call those type of stocks value traps. But it's not only for those companies. There's lots of other companies that have that same scenario. Now, on the other hand, we have companies like Tesla or Shopify or all these other, a lot of tech companies, even at Amazon, where they might trade at, 40 times, 50 times earnings, if not 60 times earnings, but they are growing and they are a high quality company. So you have to look at, is their return on invested capital high? Because there's several companies out there that have super high ROI numbers, like 35, 45%. If you can find companies like that, that means they're investing that money wisely. Not only return on invested capital, but also, how I said, net income and free cash flow. Those are 2 big drivers of the stock price and just as the business, or for the business as a whole. And so you want to make sure they're making progress in that, because if they're doing the same numbers of net income or free cash flow they were doing 10 years ago, that's not good. That means no wonder the stock is the same price it was 10 years ago. So those are a couple different things. Are they growing their numbers? Are the return on invested capital numbers high? Is their balance sheet getting better? Is the equity growing? Is the ratio of assets to liabilities growing? Things like that. So that's what I'm really want to focus on, is just make sure when you're looking into companies, whether it's like a Tesla or whatever it is, just make sure it's a quality company. And if you're paying 30 times, 40 times earnings, like another company that trades at a rich valuation is Costco. Costco normally trades over 30 times earnings. And so you might think it's expensive, but it kind of always trades at that valuation, and it keeps going up because Costco is a solid business model and people don't want to sell it. Another one right now is like a Chipotle. Chipotle has traded at very high a very high PE for years now. Like it trades at 40, 50, 60 times earnings. So every time I look at it, I'm thinking, oh, this is kind of expensive. I'm not going to buy this. Because when it does trade at those higher valuations, there is a additional risk that if they stop growing, then that PE ratio is probably going to get cut in half and investors are going to start selling off the stock. So you do have to pay attention to things like that. About a year ago, I remember this happened in Netflix. And remember, Netflix reported that they lost 2 million subscribers or something in a quarter, and the stock dropped really big. But then what happened was a month or two later, the stock came back, and now look at where Netflix is today. It hasn't stopped going up since a year ago. So you kind of have to look at those different things because that high valuation, that high PE ratio is directly correlated with how fast that company is growing and how much quality that company has. So those are the things to look for. I would say, now you don't want to overpay for any stock, so you want to look at the historical PE ratio for that stock. That's why the more data you can get, if you can get at least 5 years of data on that stock, that's really good. That's what I look for. If the company just went IPO 2 years ago or something, then you're not really sure where that stock normally trades. There's not a solid investor base for that stock yet. So you don't know, is it going to normally trade at 10 times earnings or 50 times earnings? And the reason you need multiple years of data too is because in a given year or even 2 years, the macro environment has a very strong impact on the stock price. So like in 2021, a lot of stocks were trading at really high valuations because mostly like the Cathie Wood stocks, like the Shopify, the DocuSign, the PayPal, the Palantir, a lot of those type of companies, they traded at really high valuations. So it looked like that was the new normal, but it's not, because then you see what happened in 2022, and all those valuations got cut by, some of them got cut by 70 or 80%. Like Teladoc Health, if you look at that one, that was trading at giant valuations of $300 a share. Today it's like $25. So you have to be careful there. You can't just because they're growing and they're trading at a high PE ratio doesn't mean that it's a quality stock. You really want to see consistency with their business model, and have they proven to grow their numbers, and where does the PE ratio or the valuation trade on a normal basis over the course of 5 years, 7 years, or 10 years, ideally. So those are the things to look for, but just really be on the lookout for a healthy valuation, return on invested capital, and growing net income and free cash flow. Thank you for watching, and I will see you in the next video.